Greetings, ladies and gentlemen, and welcome to the Money Metals Midweek Memo. News and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. So when I was a kid, like a lot of kids, I was really into space. And I think one of the wildest phenomena in the universe is a black hole. Now, in simplest terms, a black hole is a lot of mass crammed into a tiny space. And it has a gravitational field so strong that not even light can escape once it gets too close. So just imagine compressing the sun into a ball just a few miles across without changing its mass. A black hole is like that. And because light can't escape, you can't really see a black hole. We know it exists due to the way it affects the things around it. This gravitational pull is so strong that it actually warps things that are surrounding it. That's how we even know that a black hole exists. Because of its profound gravitational pull, once an object gets too close, it's going to get sucked in. There's absolutely no escape. So Greg Weldon, fantastic financial analyst. I've interviewed him a number of times on the show. And he did a really good, a document, a report. And he argues that we are living in a world with a debt black hole. The debt load is so massive that it is sucking everything into the economy into it. It's literally warping the economy the way a black hole warps space around it. And the debt black hole, it's getting progressively bigger and stronger. So today, I want to explain exactly why this black hole analogy is so good. Yes, Greg, I'm stealing it from you, but I'm giving you full credit. But we want to talk about how this analogy works and how this debt is going to impact us going forward. This is an extremely important topic for folks who are interested in investing, especially in gold and silver. This debt black hole is one of the main reasons that I'm still very bullish on both gold and silver. And quite frankly, even a lot of mainstream analysts out there have mentioned this debt black hole as a reason to continue to be bullish gold. So before I get into all that, though, I do want to thank you for listening to the show. As always, I really do appreciate it. I know there are a lot of things that you can listen to and a lot of things vying for your attention, so it means a lot to me that you spend a little bit of time with me every week. I would really appreciate it. I'm asking you. I'm not quite begging you, but I am asking that you would, give us the like button on the show if you like it. Give us those positive reviews. Share the episodes. It will help grow the show, and it would be very helpful to me. And I would say thank you. So, also, I just want to kind of let you know I am battling the after effects of the common cold. My nose is stopped up still. My voice is a little so we're just going to push through it. I am a hockey player. I play hurt. But if I sound funny, that's probably why. Although I guess some might argue that I sound funny all the time. But, that's a whole different issue. So anyway, let's talk about the debt black hole. When we talk about debt, I think the first thing that comes to mind is the massive national debt. Last month, it eclipsed $38 trillion, and it's growing at an exponential rate. It's wild because if you go back to 2020, the Congressional Budget Office projected that the debt would not hit $37 trillion until 2030. Oops. So get this, the U.S. public debt has grown by 64.6% in just the last 6 years. Now, of course, when people talk about the debt, everybody shakes their heads and, they lament about how awful it is, but nobody's really willing to do anything about it. At least not anybody in a position to actually do anything about it. I'm talking about the Congress critters and presidents and people with power, because spending just keeps going up and up and up. The U.S. government spent over $7 trillion in fiscal 2025. That was a 4.1% increase over the prior year. And that's despite all of the fine work done by DOGE. Turns out it's easier to point out profligate, wasteful spending than to actually cut it. Now, call me cynical, but I would bet dollars to donuts that spending isn't going to decrease in fiscal 2026. You see, political incentives make spending cuts virtually impossible, at least substantial spending cuts, the kind of spending cuts that would be necessary to really get the budget under control. Nobody wants to get blamed for cutting a program. I mean, sure, we can acknowledge that the national debt is unsustainable, but to the guy that's just worried about getting elected next year, that's a problem for another day. Nobody who wants to get reelected is going to tow the banner for massive spending cuts, at least not specific spending cuts. Sure, a lot of them will talk generically about slashing spending or, shrinking government. You've got Republicans out there talking about being small government Republicans, but they do the opposite when they get into office because it generates votes. That's just the reality. You've got a constituency out there. If you can spend money and give them something, they're more likely to vote for you. If you cut their program that they like, they're more likely not to. So that's just how the incentives work, and incentives matter. I mean, the big, beautiful bill is a great example, right? We were in the middle of DOGE, right? Every day we were getting this news about more wasteful spending and this program, and people are just appalled. And yet the big, beautiful bill passes and none of that was actually cut. And in fact, there was new spending. So this is just politics as usual. I'm not picking on Trump. I'm not picking on any particular party or politician. This is the status quo. Interesting stat. You can go all the way back to, what president was it? I want to say it was Grover Cleveland. It was back in that era. That was the last time that we had a president go into office or leave office with less debt than when he came in. Every president since then has increased the debt, every single one. Even Clinton, who, a lot of people will say, oh yeah, Clinton, he got rid of the budget deficits. He did for a couple of years. I mean, part of that was because of the big military drawdown in the wake of the Cold War. But there were several years in the 90s where we had budget surpluses. But when Clinton left office, the national debt was higher than when he came in. That's just the way it goes. And no, tariffs are not going to pay down the debt. I hate to rain on that parade. I mean, it would be great. I'd be all for it. I mean, getting $2,000, for a tariff rebate, that would be great. But it's all political theater. I mean, I'm not saying that they won't do it. We may get $2,000 tariff rebate checks, but we can't afford it. The tariffs aren't going to pay for that. And, just an idea, if you do get a $2,000 tariff rebate, I would highly recommend putting that into gold or silver. Can you imagine if you had taken your stimulus checks that you got back in the pandemic era, back in 2021, 2020, if you had taken that and put it in gold, how much that would be worth today? So, just food for thought if we do get those tariff rebate checks. But the fact of the matter is there's not enough tariff revenue to even pay for the rebate checks, right? I've even heard people floating the idea of replacing the income tax with tariffs. I mean, that would be pretty awesome too. I'd be all for it. Unfortunately, the math doesn't work. And math doesn't care about political agendas. Now, I imagine that most people hear about the tariff rebates and think, oh, wow, we must be really cleaning up on tariffs. But the reality is, most people have no clue how much money the federal government spends every single month compared to how much it's bringing in. Reality check. Tariff revenue doesn't even close the budget deficit, much less bring in enough money to pay every American $2,000. So let me just run the numbers here and kind of give you an idea of what we're talking about, because I think this is important. I think it's important to at least try to grasp the scope of the spending and borrowing problem, because I don't think people get it. I think most people understand, the government spends too much money and, we probably need to cut some spending, but I don't think people understand the scope of what we're talking about here. So fiscal 2025, and remember a fiscal year runs between September and October. So Fiscal 2026 has begun. It started October 1st. So we're talking about the last fiscal year. Tariff revenue totaled $202 billion. That was a 142% year-on-year increase. So yes, tariffs brought in a lot more revenue once Trump started raising them than we saw the year before. 142% increase. That represents about 5 months of increased tariffs, by the way. So that's not even a full year of new tariffs, because remember, Liberation Day was in April. So we're talking about, tariffs starting in May is when we started to see the boost in tariff revenue. So it's only half a year. So to give you a little bit better idea of the scope, in September, the last month of fiscal 2025, the Treasury reported $30 billion in tariff receipts. That was a 295% increase. So again, we're seeing this massive influx of tariff revenue. That's true. So I'm just going to take these numbers and kind of extrapolate that tariff income at the current level is going to run around $400 billion annually. So that's a little more than double what we saw in fiscal 2025. And I'm accounting for the fact that was really only a half year. So if we have a full year of these higher tariffs, let's say $400 billion. Let's be generous. Let's say $500 billion a year, $500 billion coming in from tariffs. Now, we also have to consider this. If, as is often claimed, the high tariffs are a negotiating tool to force better trade deals, right? It would be fair to assume that we're probably close to the height of tariff income right now, right? I don't think tariffs are going to go up a lot more from here, right? The idea is that we get trade deals with China and trade deals with these other countries, and tariffs will lower. We're using this as a bargaining tool. At least that's what I've been told. Not so much as a revenue generator. So it wouldn't be surprising if we started to see tariff revenue fall off towards the end of next year, if indeed we do get the trade deals that are being promised. So $500 billion in tariff revenue per year. That sounds pretty good, right? Until you put it into the context of overall government spending. In fiscal 2025, the federal government spent $7 trillion. That's trillion with a T. September spending alone, 1 month, was $446 billion. And that was the lowest spending level of the year because of the calendar effects. So in other words, the estimated annual tariff revenue barely covers 1 month of federal spending. How in the world are you going to replace the income tax with this? Imagine how high tariffs would have to be to generate $7 trillion every single year. The budget deficit in 2025 was $1.8 trillion. The government would need to more than triple tariff revenue just to close the deficit, and that's keeping all of the other taxes at the same level. So talk of tariff rebates, it's absurd. It's a political ploy. Of course, they can do it. They may do it, but they're going to have to borrow more money to pay for it. The tariff rebate, I'm sorry, it's nothing more than political theater. And I imagine it's being floated so that people are going to get even madder if the Supreme Court strikes down the tariffs. It's a nice little bit of a political tool. Hey, the Supreme Court took away our tariff rebate. We could never afford the tariff rebate to begin with. The reality here is you cannot solve a spending problem without cutting spending. All of this other stuff is just wishful thinking. And, when we talk about cutting spending, it really ultimately comes down to having to cut Social Security, Medicare, and probably national defense. And those are the ones that nobody wants to touch, right? Only about 27% of the federal budget is discretionary spending. By discretionary, I mean that the Congress can easily cut. The rest of it, more than 2/3 of government spending are what are called entitlements. People get mad when you use the word entitlement, so I don't really like to use it because people did pay into that system. It's true. But the money that was paid in is not covering the money that's going out. So it requires additional tax funding to keep these programs afloat. And until those big programs are dealt with, what are you going to do, right? And then there's the interest on the national debt, $1 trillion, over $1 trillion last year. So those are the biggest spending categories. And those are things you can't do anything about. So this is the situation that we live in. And this is, one part of this debt black hole, the massive national debt that just keeps growing and growing and growing. Now, of course, we can't really talk about a debt black hole without talking about other debt that's out there. It's not just government debt. American households are buried under a record $18.59 trillion in debt. Now, a lot of that is mortgage debt. So you can kind of argue, though, a mortgage debt, there's an asset offsetting. Okay, cool. Factor that out. Americans are still carrying $5.08 trillion, over $5 trillion in consumer debt. And that's up nearly $1 trillion since 2020. So we've been steadily adding to consumer debt. Consumers have been desperately trying to keep up with inflation, and they're having to borrow to do it. If you look at the trajectory, it's interesting because Americans paid down their debt during the pandemic. They used stimulus money. And of course, it didn't hurt that everybody was locked in their house and they weren't spending as much money as they normally would have. So there was a lot of debt pay down. There was a lot of savings. Savings were built up during the pandemic era. But as the inevitable post-pandemic inflation burned through the economy, people blew through their savings, and then they had to turn to Visa and MasterCard to make ends meet. And now there's an even bigger problem. It appears the credit cards may be close to being maxed out. If you look at the growth of revolving debt, so revolving debt primarily reflects credit card balances. And the Federal Reserve puts out data on consumer debt every single month. It's something that I follow pretty closely because it kind of gives you the pulse of the American consumer. And that growth of revolving debt has been slowing all year. Now, you might think that's good. People are bringing in less debt, and that is a good thing. But generally, what that's signaling is people are running out of the ability to borrow. They're worried about being able to pay it back. They're maxing out those credit cards. Consumer debt, revolving debt, contracted in both May and June after a one-off surge in April. We had a sudden surge again in July, but in August, revolving debt contracted by 5.5%, barely grew at all in September. This has been the trend. And this is bad juju for an economy that depends on consumers buying stuff to keep growing. A news organization called KPMG recently reported that the slowing growth of revolving credit likely reflects a drop in borrowing and spending by the bottom 80% of the U.S. households that are, quote, increasingly stressed. Quote, the top 20% now account for nearly 2/3 of all consumption. The top 3.3% have increased spending the most. Spending has stagnated, adjusting for inflation among the bottom 80%. In other words, average Joe, average Jane are having a difficult time making ends meet. They're not spending as much. They can't keep up with the inflationary pressure. Rich people, they're doing a little bit better. And of course, the ugly reality is that when you have a lot of money printing, when you have a lot of easy monetary expansion, this benefits bankers and politicians and people at the top. Doesn't help us at all. So we also have a double whammy. We have rising debt and we have interest rates that are also rising that exacerbate the debt problem. The average annual percentage rate right now is about 19.98%, so really 20%. And some companies are still charging rates as high as 26, 27, 28%. The average interest rate on a credit card is only slightly down from the record high of 20.79% that was set a couple of years ago. And this is despite the Fed rate cuts. So this high level of consumer debt has elevated consumer stress, as I've already mentioned. Legal Shield has what they call a consumer stress index, and they calculate it by doing polling and stuff and relating to the inquiries they're getting about bankruptcies and foreclosures and things like that. And that consumer stress index increased by 3 points in the third quarter and is at the highest level since March 2020 when the economy was shut down during the pandemic. And the source of this stress? Debt. According to Legal Shield, quote, the index has now increased for 7 consecutive months, up 8.2% in 2025, signaling continued financial strain among American households. Legal inquiries related to bankruptcy rose sharply, while foreclosure and consumer finance issues remain elevated. So that was from the last Legal Shield report, which just came out for the third quarter. Meanwhile, the New York Fed reported that overall delinquency rates in the third quarter remained, quote, elevated, with 4.5% of all debt in some stage of delinquency. Now, that's not a whole lot, but it is a whole lot. That's a lot of people who are behind. Credit card and student loan delinquencies have increased at the fastest rate. The overall debt flow into serious delinquency was 3.03% in the third quarter. So that's a big chunk of people that are seriously delinquent. That was up from 1.68% last year. So you can see this building stress, right? We've had year after year of price inflation. People aren't catching up, right? Wages aren't catching up with the inflationary pressure. People are struggling. You see that in these consumer stress indexes. Credit card delinquencies are rising even among consumers with strong credit scores. According to an outfit called Vantage Score, there was a 47% year-on-year increase in late payments by people in the prime segment. We also see tepid growth in non-revolving debt, and this also reflects consumer stress. When I say non-revolving credit, I'm primarily talking about student loans, auto loans, and loans for like big ticket durable goods, like if you borrow money to buy a refrigerator or something like that. That's been running around 2% for a couple of years now. It was 5% before the pandemic. So when you talk about this, in some ways it's good, I think, that people aren't accumulating as much debt. I'm of the opinion that debt generally is problematic for consumers. But in the world that we live in, where debt is kind of what makes the world go round, when people stop borrowing, that's usually indicating stress in the economy overall, that the economy is contracting. And the bottom line here is people are having a hard time. They're having a hard time keeping their heads above water, much less saving anything. And of course, that doesn't bode well for the economy of the future because capital expenditures flow out of savings. Without savings and capital expenditures, businesses can't grow. They can't grow for the future. So really, all the powers that be can do right now is keep artificially suppressing interest rates, hoping people will keep digging the debt hole deeper and deeper. Needless to say, this is probably not the best plan. When I talk about investing in gold and silver, people often tell me, man, I'd love to. I just can't because nobody has any disposable income anymore. They're not saving, but you need to, right? We talk about it all the time. If you want to preserve and protect your wealth, you've got to have gold and silver. Money Metals has a program that can help if you are interested in growing a precious metals portfolio, but you don't have, $5,000 to go buy an ounce of gold or a bunch of silver. We have a installment program. For as little as $100 a month, you can accumulate gold and silver over time. So you get a fraction of gold, and eventually you're going to build up and you'll have an ounce of gold, and then later you'll have 2 ounces of gold. So it's a really good program that I just wanted to call your attention to because this is what we need to do. We can't fix this, right? The debt's not going to suddenly go away. We have to be proactive and take care of our own financial situation. And this is one thing that you can do. And this program provides a pathway for folks to begin to save in precious metals without having to try to break the bank to get started. So something to check out. I'll link to it on the show notes and something you might want to check out. So we've talked about government debt. And I should also mention the fact that, the U.S. is not alone. There are a lot of governments that are buried in debt. The global debt bubble is massive as well. So I'm just focusing on the U.S. right now. But remember, when I talk about this is not just an American debt black hole. We're talking about a global debt black hole here. So I want to touch on corporate debt just real quick. Also at record levels, and this is straining a lot of companies, and you see that in corporate bankruptcy data. Corporate bankruptcies hit a 14-year high in 2024, and the pace continued through the first 7 months of 2025. Through those first 7 months of the year, 446 companies filed for bankruptcies. This was the most for any 7-month period since 2010. So that includes the pandemic. So 2010, we're talking about the midst of the Great Recession. We're seeing bankruptcy levels at the corporate level right now running at the pace that they were back during the Great Recession. So now you can see why Greg Weldon calls this a debt black hole. It's massive. It's government debt. It's consumer debt. It's corporate debt, and it is affecting everything in the economy, and it is going to continue because as long as this debt black hole exists, policymakers are going to be forced into making decisions that aren't necessarily going to be great. So how do we even get here? How do we get this massive debt black hole? Well, the fact of the matter is the Federal Reserve, the very organization that's trying to fix all of this inflation and everything, it's the Fed that incentivized the debt with nearly 2 decades of easy money. It kept interest rates at zero for 7 years after the 2008 financial crisis. By 2018, the central bank had only managed to push interest rates back to 2.5%. 11 years or 10 years, a decade after the financial crisis, interest rates were still only 2.5%. Now, the next year, they started cutting again. 2019, they were cutting. They cut interest rates 3 times that year. And then we had the pandemic, which gave them an excuse to go to zero again, which they did. And of course, they didn't aggressively start raising rates until March 2022, when they could no longer convince everybody that inflation was transitory. So basically, we had 15 years of artificially low interest rates. And so now today we have an entire generation of people working in the financial sector who think that's normal. Right? They came in, right before the financial crisis or maybe right after it, and their entire careers, interest rates have been, zero. 2.5%. So no wonder when we got to 5.5, people were like, oh my gosh, interest rates are so high. 5.5 is not high. It's not even above the average that we've had in the modern era. Basically, 5% is kind of normal, right? Or below normal. But we have all of these people who think, no, zero is normal. So it's no wonder we have so much pressure to keep interest rates low. It's by necessity, but it's also just kind of ingrained into people. So when you understand this debt black hole, a lot of things that don't really make sense start to kind of come into focus. They start to make a little bit more sense. For instance, why would a central bank cut interest rates when the CPI is still at 3%? Right? The measure of inflation that is most commonly used is a full percentage point above the target, but we are aggressively cutting interest rates. We are ending balance sheet reduction. As I talked about in the show last week, they're probably going to go back to quantitative easing. Why would you do this when inflation is still arguably hot? Because there is a debt black hole and the economy cannot function in a normal interest rate environment. We need more easy money to keep the air in the economic bubbles that were blown up by the stimulus. But more easy money has another effect, right? It makes the debt black hole that much bigger. So we're kind of in this cycle, right? They have to keep feeding the debt black hole in order to keep the economy limping along. I mean, basically, we have a situation here where the central bank, the Federal Reserve, is being forced to keep doing the very thing that gave us this big problem in the first place because the problem exists. In order to fix the problem, in order to deal with the debt black hole, it would require much tighter monetary policy. And this is the problem. This is what happens when you have central planners trying to centrally plan things. This is what happens when you have, bureaucrats tinkering with prices. And that's all Fed interest rate policy is. They're playing with the price of money. Imagine if you had, a panel that just decided to arbitrarily set prices for iPhones. I guarantee you that the iPhone market would become a complete train wreck if that happened. Because there's no way that this committee, there's no way that these central planners can know all of the things that they need to know to make those kinds of decisions. It's absolutely impossible. It's the knowledge problem. That's what we're dealing with. But they've created this situation. We have this massive level of debt. And so you have to have artificially low interest rates to keep the economy going because of the debt, or else the debt bubble's going to pop and that'll wreck the economy. So they don't want to wreck the economy. So basically what's happening is we're getting more of the same policy that created the debt black hole in the first place. As Greg Weldon put it, we're getting more of the same with an intensified environment as we move deeper into the debt black hole and more desperately try to generate more powerful propulsion to push against the gravitational pull of the black hole, aka printing more IOUs, monetizing debt, and debasing the purchasing power of the US dollar. Right? That's what we're doing. We're trying to get out of the pull of the debt black hole by making the debt black hole bigger. Let me reiterate. The only defense against the effects of the debt black hole is to do more of what created the debt black hole in the first place. We live in a world where money printing isn't just for emergencies, right? I remember Ben Bernanke, I talked about this last week. Ben Bernanke, when he started quantitative easing, he said, oh, no, we're not monetizing the debt. This is an emergency situation. And once the emergency is passed, we're going to get rid of all of these bonds that we're buying. We're going to soak up all of this liquidity. Everything will be fine. Never happened, right? Today, easy money, what was once considered, extreme monetary policy for a crisis, it's the norm now. We have to have it just to keep the economy limping along. And I do mean limping. Get this. We now need more than $1 in new debt to generate $1 in GDP growth. We crossed the line where $1 of GDP growth cost less than $1 of debt back in 2018. So this is necessary. Inflation and debt are the foundation of this economy. So in last week's show, I talked about the fact that the Fed is likely going to have to go back to quantitative easing because of all of the debt in order to sustain the federal government's borrowing and spending. When I think about it, it actually probably would have been better to do this show first and do last week's show this week. But alas, that's not how it worked. But if you want to get the nuts and bolts about money printing and how all of this is pumping up the inflation monster, and you didn't listen last week, make sure you go back and catch last week's show. But the too long didn't listen summary is we're talking about more inflation. That's really what the debt black hole is all about. It exists, and it means we're going to end up with more inflation. Remember, inflation is on purpose. Trump claimed the other day in a social media post that there's, quote, virtually no inflation. I'm sorry. That's just political posturing. The CPI is still 3% annually. That's a full percentage point over the supposed target. But even if they were on target, there would still be inflation, right? They plan to devalue your dollar by 2% every single year on a good day. That means you're losing purchasing power every single year. That means every 5 years, your dollar buys 10% less. Every 10 years, 20% less. Compounding. This is the plan. There's never a situation where there's virtually no inflation. That's not a thing in a fiat system. For months, I've been talking about the catch-22 facing the Federal Reserve. It needs to hold interest rates higher for longer. And I would argue there's a case for raising rates right now in order to deal with the inflation. When you look at the CPI, it's been stuck basically in the same place for over a year. When you look at the amount of inflation that was created during the pandemic, when you look at the amount of inflation that was created during the Great Recession that they never even unwound, all of that's still floating around out there, right? So I could make an argument for rate hikes. But there's also a really good argument for rate cuts. I mean, we've heard it, right? Because an economy in proximity of a debt black hole can't function with normal interest rates, right? We have a federal government that is paying over $1 trillion every single year just on interest on the debt. Second largest spending category in the entire federal budget. So the Fed has made a choice. And this is what's important. The Fed has made its choice. It picked inflation. This is not a policy that you can just protest. It's not a policy that you can vote away. It's not going to change. This is status quo in a fiat system. Again, let me emphasize this. On a good day, the plan is to devalue your money by 2% every single year. And of course, we've talked about this before. The fact of the matter is the CPI is not really a very good measure of price inflation. It understates price inflation. The formula is designed to understate price inflation. It's probably twice, maybe 3 times what the CPI is telling us. That is what the government is doing to your money. And once inside a debt black hole, there is no escape, only acceleration. All you can do is try to navigate the world in which you live, right? Stay away from the black hole as best you can and get ready for the inevitable impacts. We know it exists. We know what the powers that be are going to do. There are ways to shield yourself. I saw a stat the other day that reveals just how bad it is. This is per JP Morgan. Income for Americans, adjusted for inflation, is essentially the same as it was 5 years ago. That means most U.S. workers aren't getting any richer. And for a lot of folks, they're actually getting poorer. So, people have gotten raises, but those raises aren't keeping up with the devaluation of the dollar. And it always works like that. I hear people sometimes they'll say, oh, Mike, inflation, it's not really that bad because, prices are going up, but your income is going up too. So it kind of balances out. It never does. Eventually wages do catch up with the inflationary pressure, but it's always a lag. You're always getting hosed. It's the people who are getting that money first, the bankers. They're the ones that are making bank on this, pun intended. But again, all you can do is prepare yourself for the impacts. We can complain about it. We can gripe about it. And maybe that's what it sounds like I'm doing, but that's not really the point. I'm trying to emphasize and make clear the world we live in and provide some way that you can cope with it. Because in my view, that's kind of what we have to do when it comes to government, right? Government does a lot of stupid stuff. We have to figure out how to cope with it and work our way around it. One way to get poorer is to save in dollars, to take those dollars, whatever you have left after you deal with the higher prices. If you have anything left, you don't want to save in dollars because they are being relentlessly devalued. You need real money. Weldon posed it as a question in his document. Got gold? You want to have gold. So this is a great time to talk to a money metals, precious metals specialist. All you got to do is call 800-800-1865. Talk to these folks. They're a great resource. A couple of months ago, I spent a few days out in Idaho where the money metal offices are. I got to meet a lot of the folks that, pick up the phone when you call. These are fantastic people. They're very smart, very knowledgeable. They want to help you. They're going to answer your questions. They're going to help you figure out how precious metals can fit into your investment strategy. All you got to do is give them a call. They're a great resource. Now, I know a lot of people don't like to talk on the phone in this day and age. That's cool. You can go to moneymetals.com. You can chat with the precious metals specialist online. Or if you just want to buy gold and silver, you can do that straight from the website. Order what you want. We'll ship it up, package it up and ship it to you. Or you have the option of storing your gold and silver in our state-of-the-art bullion depository out in Eagle, Idaho, which is a fantastic, secure vault. So do it today, 800-800-1865. Oh, and by the way, if you want to get a copy of Greg Weldon's debt black hole report. I will link on the show note page to the spot where you can pick that up. It's worth reading. It's a really nice PDF, a lot of graphs and stuff. He gets into depth on what I've kind of given as an overview. So you can check that out over at moneymetals.com/news on the show notes page. So with that, we're going to call it a wrap for this episode of the Money Metals Midweek Memo. You can get more information about everything that I've talked about on the show today and a whole lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your email inbox, make sure you sign up, get on our email list. Of course, you can subscribe to the Midweek Memo on your favorite podcasting platform. And when you do, you'll also have the opportunity to tune into our Market Wrap podcast, which runs every Friday, where you're going to get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold and silver, economics, and investing. This week, I'll be talking to Michael Pinto, a fantastic analyst, so that'll be worth checking out. So do that. Again, thank you for listening to the show. Please give us those likes, share the episodes. I hope you have a fantastic rest of your week, and I will be back behind the microphone again next Wednesday.